So let's begin study club. Today we're going to be talking about the introduction or an introduction to understanding your profit and loss statement. And to kind of go through this with us is going to be Larry Guzzardo. And Larry Guzzardo is highly sought after dental practice management consultant and international speaker. He's recently came back from England, and his skill and talent is offering practical, common sense solutions to improving dental practice productivity. In addition to his consulting business, Larry is a faculty member at the Dawson Academy, and I say most importantly, he is our All-Star Dental Academy head instructor. So please welcome Larry Guzzardo.
Thank you, Alex. You know, as usual, every month when we have these study clubs, I can always count on you for a rousing introduction. And I'm going to go ahead and get started. Tonight, I wanted to give everybody who's listening an introduction to understanding your profit and loss statement. And I don't want to make this complicated because we're not CPAs, but I want to help you work closer with your CPA because they're a wealth of information. They can help you not only make sense of your expenses, but they can help lower your taxes, help you invest your money, you know, more sanely. And so there's a great way that you can work with them. So that's why I wanted to give you this introduction as a way of being able to start a conversation with your own CPAs, because these men and women are a huge asset to dentistry and can really help you a lot if you know what questions to ask. So let's just go ahead and get started. When I'm consulting with clients and we're looking at our expenses, what I do for them is I divide them into two basic categories. And the categories are the major expenses of the practice, and I'll put up a slide that shows you what makes up major expenses. But major expenses in the practice are going to comprise about 50% of what you spend every month. So that's why they're called major expenses. They're not a lot of items, but it costs you a lot of money to operate those expenses. And then we have a group called general expenses, and it's a lot of small items like the telephone and postage and office supplies and things like that. But those expenses are going to comprise about 10% of what you spend every month. So if we add major expenses and general expenses together, what you have there are your total operating overhead. And what we mean by that, what I mean by that is this is your cost of seeing a patient. And so it's important that your profit and loss statement be divided up this way so that you get a look at what it costs to actually see a patient. And there's a lot of debate, you know, as to what's included and what's not included. What I'm going to provide you with is what I consider just generally accepted major and general expenses, so that when you're talking to your peers, you know, the same things are included. And I'll explain as I go along. But the way I want you to look at your operating overhead is very simple. It's two categories. It's your major expenses and your general expenses added together. And when we do that, your total operating overhead, the cost of seeing a patient, should not run you more than 60%. And of course, I'm talking not more than. You'll hear numbers that are much less, or you'll hear a lot of people say, I'll get your overhead down to 50% or 55% or whatever. And I think that's great, because obviously the less your overhead is, your operating overhead is, the more operating profit you have, and I'll explain that. But your cost of seeing a patient shouldn't be more than 60%. So your major operating expenses should be listed on your P&L, and I like that to be the first items that you see. And it's just these items, and in the notes for today's study club, we'll be providing a PDF of all these slides, as well as a chart of accounts for you. So you don't have to quickly write all this down. We'll have that available for you. But your major expenses are things like dental supplies, laboratory, payroll taxes, practice promotion, occupancy, staff wages, hygiene wages, and then fringe benefits. When you add all this up, and I put the percentages that I would recommend that you use for your budget, that comes to about 50%. So the question always comes up about salary expense and how much it should be. Note here, I have a figure for staff wages, so that would be the clinical staff along with the, not the hygiene staff, would be the clinical staff and the administrative staff along with the hygienist. That should be no more than 20%. That's their gross wages. Then you add on to that fringe benefits, which I would budget 3%. And then payroll taxes is going to be about another 2%. So the total compensation to your staff would be 25%. That changes a little bit, the way you would break that down. If you have just 2 in the business office, 2 dental assistants, and then 1 hygienist, the 20% is broken out. 8% is spent at the business office, 6% on dental assistants, and then 6% for your hygienist, and that's how you get your 20%. However, if you have 2 hygienists, then the breakdown changes slightly, and it looks like this. Because of the extra revenue that you're going to generate, because you have this other hygienist, and I can see on my slide it should say 2 hygienists, not 1 there. But if you have 2 hygienists, then your business office will go down to 6%, your dental assistants will stay the same, but your hygienist expense will probably go up to about 8%. And so that's where you'll get the 20% for that group. The general operating expenses for your practice, again, it's a long list of little items like your professional fees, bank service charges, dues and subscriptions, insurance, laundry, office supplies, postage, miscellaneous licenses and taxes, things like that, your telephone, internet cable. But when you add that whole list up together, it is 10% of what you spend every month. So we add those 2 together, and then if you take your total collections and you subtract your total operating overhead, which is just the 2 categories that I had mentioned, you get what's called your operating profit. And so you can do the easy math here. You can see that the operating profit should be approximately 40%. Operating profit is the money that the dentist has left over for the doctor's discretion. And so depending on, the type of loans you have or the other expenses, the doctor could put this 40% in his own pocket. Now, that wouldn't be reality because out of operating profit, the doctor does have other additional expenses. And so it's out of this money that you pay for loans. You would pay your student loans. If you were building, new construction, you would subtract that out of here. If you're buying new equipment, that would come out of here. That would be your additional expenses. Then there'd be the doctor's expenses, and that would be things like the doctor's continuing education, doctor's taxes, doctor's insurance. So any expenses that are related to the doctor, even the doctor's salary comes out of operating profit. And then you have what's called net profit. And so that would be the final money that's left over. That's also the figure or the amount of money that you would pay federal income taxes on, depending on what type of corporation you're set up in. So what I wanted you to see here was your additional expenses that come out of the operating profit would be things like depreciation, the equipment, interest payments, loan payments, facility upgrades, new equipment, the associate salary, so on and so forth. The doctor's expenses are things like their retirement, professional travel, taxes, their own salary, continuing education, and all that. That comes out of operating profit. So what I hope you're seeing here is that operating profit is very, very important for a practice because if you look at all the expenses that come out of there, there's probably nothing that you can live without unless you didn't have to borrow money to buy your practice or you didn't have to borrow money to go to school. So if I just state this out again, if you take your operating profit and then subtract your additional expenses, then the doctor's expenses, and then even the doctor's salary, then we have some net profit that's left over. And so that's the basic way that I want you to look at your profit and loss statement. More often than not, what you'll find from your CPA, and they're not doing anything wrong, actually they're doing their job, is what you'll find is they'll take your revenue and then they'll just minus all of your expenses and then you'll get down to net profit. and then, that's what you may or may not have to pay tax on, depending on the type of corporation that you have. Tax on, depending on the type of